Hello, I'm Troy Sainsbury, mortgage planner in Madison, Wisconsin. I'm talking to you about equity management, how to manage your mortgage to increase your safety, liquidity, and rate of return. This applies to everyone, from purchasing your first home to refinancing the last home you'll ever live in. I was a financial advisor for 4.5 years, and I've been a mortgage planner for over 6 years, educating clients about suitability, taxation issues, and investment return, because it's my goal to help my clients grow and protect their wealth. Why is managing our home equity so important? While the home is usually the largest asset that people have, the mortgage is usually the biggest liability. That's why there's not one plan for everyone. The decisions we make about our mortgage affect all areas of financial planning, and we'll talk about liquidity, safety, and rate of return. It's important because opportunities and emergencies arise for everyone. Being prepared is part of financial planning. Managing the mortgage is important because a great rate on the wrong mortgage can end up costing thousands of dollars in the long run. While we know that paying off the mortgage is better than consuming and spending, we'll see how investing can be even better. Now we have options of what we can do with our money, and that's why we have to understand opportunity cost. Opportunity cost is the foregone investment we could be making in favor of the one that we are making. We have the option to pay down our mortgage or invest in retirement. We can keep it in cash or consume and spend it. We look at those options, we look at which will grow wealth the most, which costs the least, and then we take into account any other considerations. When making those decisions, we have to understand certain principles such as liquidity. Liquidity is access to our assets. Now on one hand, a paid off home has almost no liquidity. In order to get access to that equity, we would have to either sell the home or borrow and take out a mortgage. To get a mortgage, we would first have to have income. But if we're retired, laid off, or changed jobs, we may not qualify. We also have to have good credit. Even if we've paid our bills on time though, if someone's stolen our identity or there are mistakes on the credit report, our scores may be lowered, and again we may not qualify. We also have to have cash reserves. Banks are telling us we have to have money before we can get it. Home also has to be in good condition. Banks are not going to lend money on a home that needs repairs. And even if we have income, good credit, cash reserves, and the home's in good condition, we also have to consider the state of the credit markets. Here in 2009, banks are not as willing to lend money as they used to be. On the other hand, we can have cash, which gives us instant access to our money. If we want to take advantage of a business opportunity, take care of an emergency, or buy something on sale and get a discount, we can do that instantly with cash. We also have to consider safety. Safety can be thought of as the risk of losing money. Now, would we put all of our money in only one investment? I don't think so. Because we don't know which investment will be up when we need the money. Some investments move together, while some move opposite. Would you put all your investments in oil futures? Probably not. Would you put all your retirement account in one company stock? I hope not. That's why people say to diversify. They say don't put all your eggs in one basket, because we know that commodities like real estate are volatile. Another principle we have to understand is rate of return. When we make an investment, the return equals the growth minus the expenses. Now when we buy a home, if it grows in value and we go to sell it, the buyer doesn't care how much we owe. If we're going to buy a home in this neighborhood, and 3 homes have sold for $200,000 each, and we're going to look at home A and home B. Home A has a mortgage for $100,000. Home B has a mortgage for $160,000. Which home would you be willing to pay more for, home A or home B? Neither, because the mortgage has no impact on market value. Another expense we have to remember is taxes. Now, homeowners are allowed to deduct the amount of mortgage interest they pay from their taxable income here on Schedule A of their tax return. Now, while we see that mortgage interest is tax deductible, we also see that personal interest such as credit card and car loan interest is not tax deductible. So what's this mean? Well, for every $10,000 of gross income, we will pay about 30% or $3,000 in taxes. Our take-home pay is $7,000. And with a $200,000 mortgage at 5%, we will pay about $10,000 of mortgage interest per year. But now remember, we're taking that $10,000 of mortgage interest and writing it here on Schedule A of our tax return. So now, on that $10,000 of income, we will pay 0 taxes instead of $3,000. And because of this $3,000 in savings, our actual cost of borrowing on the $200,000 mortgage becomes $7,000, or 3.5%. Now if we had $200,000 lying around, we could pay off the mortgage and save $7,000, or we could invest it in a retirement plan such as a Roth IRA, or here in this municipal bond fund. Because we're lending money to municipalities, we could safely expect a 4% return. On the $200,000, that would be an $8,000 return. Now, would you rather pay off the home and save $7,000 or invest and earn $8,000? I would rather earn $8,000, then I could pay the mortgage interest of $7,000 and still have $1,000 left over. When making these decisions, we have to remember to ask ourselves these questions. If an emergency or an opportunity arose, would you rather have home equity, where you have to apply and qualify for a mortgage, or would you rather have instant access to cash? Would you rather have all your eggs in one basket, or would you rather be diversified? In that scenario earlier, would you rather pay off the home and save $7,000, or invest and earn $8,000? These seem like obvious answers, and that's why I like to remind my clients that we live in a different world today. If a bank gives you a mortgage, they cannot turn around a few months later and ask you to pay it all back or foreclose on the home. If you pay on time, you keep your home. We also have to remember that mortgage interest is tax deductible. Personal interest like credit cards and car loans, not tax deductible. We know we have to diversify our investments because commodities like those oil futures and real estate are volatile. And we know we can no longer depend on Social Security for retirement, and that's why we need a plan of our own, such as an IRA or 401k. So what's the best strategy for managing home equity? Well, for most people, it makes sense to avoid biweekly payment plans and avoid the 15 and 20-year mortgages. Instead, we should be saving and investing to diversify and stay liquid, and we should maximize our tax savings in order to grow and protect wealth. Now, everyone's needs are different, but if you have any questions about how best to manage home equity, you can give me a call or an email anytime, or visit my website. I look forward to hearing from you.